What happens when an industry built on timeless tradition faces rapid market evolution? The Swiss luxury watch landscape presents us with a fascinating paradox right now. It's been dominated by boom and bust narratives, but the real story is far more nuanced. Let's tackle a question that's creating buzz across watch circles. Is the Swiss luxury watch industry truly experiencing a downturn, or are we witnessing something more profound? A strategic shift toward a new luxury paradigm. To unravel this mystery, we need to look beyond the surface numbers. Our analysis will weave together three distinct perspectives that paint the complete picture: how individual brands are performing, what's happening at the corporate group level, and perhaps most tellingly, how different price segments are evolving in response to changing consumer preferences. Think of this as piecing together a complex mechanical movement. Each component reveals part of the story, but understanding how they work together shows us where the industry is truly headed. Welcome back. My channel provides independent market analysis. I'm not a watch dealer, and I don't do paid posts or sponsorships. I buy my data from watch charts to get the latest numbers. Now, let's break down how the Swiss watch market actually structures itself. And I'm not talking about how we collectors think or feel about these brands. This is pure market positioning based on price points. This is how the manufacturers really think about their market position. At the summit, we have the ultra luxury segment where Patek plays in the 100K or greater territory. These aren't only watches anymore, they are serious investments. The premium luxury bracket between 50 to 100K is where you'll find powerhouses like Audemars Piguet and Lange. These brands are competing for those significant milestone purchase moments. In the luxury segment, ranging from 20 to 50K, we see Vacheron, Breguet, and Rolex. Yes, you heard that right. Rolex sits in this tier despite what the gray market might suggest. Finally, the entry-level segment under 20K is surprisingly packed with prestigious names. You got everyone from Blancpain to IWC, Hublot to JLC. Don't let the quick entry fool you. These are serious watchmaking houses. Now, this segmentation tells us something crucial about the industry strategy. But here's where it gets interesting. Look at where these brands really stand. The first chart shows the index values. Think of this as the market's current pricing power. Patek Philippe towers over the field at nearly 200,000, while AP follows at around 100K. There's quite a gap before we hit Lange, VC, and the others. But again, it gets really interesting. Look at the percentage changes. Every single brand is in the red. Now, the severity varies dramatically. GP and Moser have taken the hardest hits, down 15 to 12%. Meanwhile, powerhouses like Rolex and Patek are showing smaller declines in the 2 to 3% range. What's fascinating here is that the brands with the highest index values generally saw small percentage drops. It's like watching the luxury watch market perform a stress test. The ultra luxury segment is proving more resilient than the entry luxury brands. Now, let's zoom in on the outliers. They tell us a fascinating story about market dynamics right now. Ulysse Nardin emerges as our best performer with only a 3.6 decline and an index value of 11,000. What's remarkable here is that Ulysse, positioned in the entry luxury segment, has shown impressive resilience. On the flip side, we've got our three biggest decliners, and this is where things get interesting. Girard-Perregaux took the hardest hit at -15, followed by Moser at 12.7%. But perhaps the most surprising is Vacheron, taking 12% decline, which is, especially given their higher index value of 34,000. What's particularly telling here is that market position doesn't guarantee protection. Look at VC, a prestigious maison with significant heritage and a higher price point, facing similar challenges as brands in other lower segments. This suggests we're seeing something beyond a market correction. We're witnessing a shift in how collectors value different brands regardless of their traditional market positioning. Looking at price segments tells an even shocking, clearer story. And notice something crucial here. We're seeing, once again, red across the board. Not a single segment shows gains. The pattern is striking. The under $500 segment took the hardest. It had 16%, while pieces over 100K only dropped 2.2%. It's not random. There's a clear correlation between price point and stability. The higher you go, the smaller the decline. Obviously, the higher you go in terms of the income bracket, they still have discretionary income. What's particularly telling is how this plays out over time. Look at the 3-month, 6-month, and 1-year trends. The decline is persistent and systematic. The ultra-luxury segment above 100K has essentially created what appears to be a price floor, showing remarkable stability even in this downturn. Let's put these numbers in perspective. The spread between the best and worst performing segments is striking. A full 14% percentage points. At the top, 100K watches, again, showing stability with only a 2.2% decline. Compare that to the market average of 6.9%, and you start to see the story. Now, the real pain is at the bottom. The sub 500 watches plunging, as I mentioned, 16%. It's not simply random market volatility. This is a clear pattern showing that price segment is becoming a key indicator of market resilience. Think of it as a barbell effect. Ultra luxury holding steady at one end, while the entry-level market takes the brunt of the correction. We're watching a fundamental reshaping of how different price segments perform. What we're seeing in the watch market isn't happening in isolation either. Let us look at the broader picture. The broader luxury segment, there's a seismic shift happening, particularly in key markets like China. The numbers are staggering, carrying down 39%, Burberry dropping 30%, and even luxury powerhouse LVMH dropping 13%. This parallels what we've observed in the watch market, a systemic readjustment across price segments. What's particularly telling is that this isn't only a temporary dip. LVMH's performance is its worst since the 2008 financial crisis. This suggests we're witnessing a fundamental shift in luxury consumer patterns. Now let's get to the heart of the matter. The data we've seen from watch markets to luxury conglomerates reflects a deeper issue: broken trust. 50 million consumers have voted with their feet, leaving the luxury market entirely. The pattern is clear. While ultra-luxury watch segments continue to show stability, the broader luxury market has faced much steeper declines. Why? As Marie Driscoll points out, brands have been raising prices without delivering corresponding increases in value, innovation, or service. It's about more than market correction or changing taste. This is about value proposition. When luxury brands push prices without enhancing the core luxury experience, consumers eventually push back. The varying declines we've seen across price segments aren't random. They're a direct response to this broken promise of luxury value. See you in the next video.